The most expensive market ever. That is correct. How high? Let's hear from the legend.
Whoa, Nellie!
Stay tuned, we'll discuss this and much more. Hello, this is Michael Loftus for Wealth and Wisdom TV. First up, don't forget to subscribe to our channel. You can also click Show More for additional information on today's video, links to articles, charts, etc. We also have a white paper out there that you can download. So, question from a viewer. Well, this is a question from a viewer, but also several of my clients last week as we did our year-end reviews. How do you know when to get out? Now, obviously that's a difficult question, but you look at some of the headlines from last week, the articles, the stock market never goes down, tax reform has released the bulls. No question this thing is going. So I'm not going to talk about it right here. I'm going to quickly go through the charts. Okay, and then we're going to show some specific charts to help you on this question. So let's get right to the numbers. Week ending 112. Obviously, very strong across the board. One of the things we did finally see were the small and mids showed some life. That's one of the reasons, as we talked about last week, we added some more allocation to our mids. We already had the smalls going into this year because of tax reform. So let's get to the big charts. So the big charts, we're going to start with the S&P. You see it straight up. That is a bullish trend line. Momentum continues to point up. Are we overbought? Absolutely. Going to talk more about that. How about the Dow? How about 8 all-time highs year to date? 71 last year. The difference is we've only had 9 trading days and it's up 8 of those 9 days. NASDAQ, as you would expect, straight up, beautiful line, nice and bullish, momentum turns up, and then on the top, relative strength, overbought, not quite as bad as the S&P and Dow. How about market breadth? Well, 200-day moving average. Those companies above the 200-day moving average, as you would expect, strong. 82% for the S&P, 73 to 78% on NASDAQ. Big move there. Mid caps up to 77, and smalls stay strong at 71%. The 50-day moving average, which is obviously going to show how we look in the short-term range. Well, really big move last week on the S&P from 73 to 83. NASDAQ, how about 60 to 88% of companies above their 50-day moving average? Mid-cap 68 to 76, and smalls, you see it in the numbers, from 59%, excuse me, to 68%. So, how expensive are we? Real expensive. Here's the CAPE, cyclically adjusted price earnings. You can click below and take a look. The highest we've been since 1929 outside of the dot-com era. So, awfully expensive. Now, if you take those numbers and you say, well, let's go back. I've showed this chart before. Your S&P line going straight up there. And what I did was I overlaid, let's say if we were just 20. If we went to 20 on the CAPE, that would be a 23% correction. If we went to fair value, meaning our long-term average, that would be a 40% correction. Just get back to fair value. And if we were to go to 10, it'd be a 60%. Not saying that's coming, but that's how expensive we are. Now, last week I showed this chart, the weekly on the RSI, Relative Strength Indicator, which tells you whether or not it is expensive. Last week we talked about the highest we've seen since 1958. But wait, as of Friday, it's the most expensive since 1929 on a weekly chart. And if you can zoom in there, Michelle, look at that wedge on that S&P. Something has to be resolved here. We're going to break out or break down to be determined. How about being the most expensive ever? Here's the Dow. the Dow monthly chart, you can see it. I've got a red highlight there. I'll have Michelle highlight in 1928, okay? The most expensive since the crash. That's real. Now, that being said, the market still keeps going up, but obviously puts a little bit of concern and pause as we move forward. We'll talk more about that in a couple minutes. So let's get to the sectors. Across the board, as you'd expect, seeing participation everywhere. Had a little bit of movement last week on utilities and retail, okay, and also consumer staples, but they are the ugly ones so far this year. Going to show oil one more time here. We see that breakout on a daily chart. You have your golden cross where the 50-day goes above 200, but here's your weekly chart. So we got absolute confirmation on Friday. Friday matters most. You can see we went up against that resistance, held it, and stayed strong. So as we mentioned, we started tiptoeing in some accounts, and we went into oil across all our accounts heading into this year. Now, what about any opportunities? Well, I'm going to show this chart. I missed it, but I'm going to show it because I think there still might be an opportunity. Airlines. Started looking at this back in October. Very volatile sector, especially with rising oil prices. But look, here's the golden cross. We'll have Michelle put a mark there. You see it in yellow. 50-day going above 200-day moving average. Getting a little bit overbought, but that's not so bad. This is the daily chart. And if I look at the weekly chart, again, breaking above its resistance and closing a Friday there, that's very bullish. So I'm going to watch this for some accounts that were sitting in cash. Not a big move, but being there's not a lot of opportunity, this might be one of those. So bonds. Last week, Bill Gross, the used-to-be bond king, said, we are entering the bear market in bonds. Well, I don't know about that. Beginning of the year, I showed this chart saying it's the most important chart for 2018, and I would agree. Okay, you can see the trend line here on your 10-year treasury on the monthly going down. Okay, I don't think 2.6 is the number. If we break that upper channel, which is about the 3% range, yeah, we're going to have some issues as it pertains to bonds. But I don't think we're there yet. If we do get some volatility, that should, in theory, push bonds down again, but to be determined. 10s minus 2s, just a little bit of a move last week. We went up a little bit, so still pretty low, below that 1%. So, answering the question at the beginning, how do we know when to get out? Nobody does. Absolutely nobody. If they did, they would be a multi-trillionaire, right? Because it's impossible to time the market. Now, you hopefully have some processes in place that can help you on when to enter and when to exit, and that's what we'll talk about here. So, here's our monthly chart of the S&P. Remember this or pause it. We'll make sure I'll have Michelle have links to these charts, but you can see on the monthly below, momentum. When it's above, black above red, we'll keep it simple, things are good. And look at that line, pretty smooth. Had a little bit of choppiness here and there from the crash of 09. So that is a good looking chart. Let's go to 09 and 02. Now you can see it here, the negative crossover on momentum. All right, and you can correlate that. I'll have Michelle draw a direct line up top. Okay, and right there is when you would get out because you have a negative crossover on the monthly view. Now what I want you to look at is beforehand, you kind of see the market. It looks smooth because it's a monthly chart. But let's bring up the daily chart. Wow, look at that. Something we surely have not seen in the last 2 years. That, my friends, is volatility. That's the kind of thing we'll see before we get to that point. Has it happened before? Yes. Here is 2006 to 2010. There's your negative crossover, and then you would exit the market. Simple. You could also say the 50 going over the 200 is another opportunity. And then what about beforehand? Do we see anything beforehand? Yes, look at the volatility. So there are some ways to prepare yourself, and of course, we'll be here to help guide you on that decision. AAII, wrapping things up, the consumer. Last week, highest level in 7 years. Quite a pullback down into not quite normal, still strong on the bullish side, and then neutral and bears. So very interesting here. More bears this week, and we will continue to watch that. Here's your institutional money managers, and you kind of see the trend here. They maxed out at the beginning of the year and have slowly been reducing their equity risk. Do they know more than consumers? We'll see. Not uncommon. Take profits, slowly build up for the next pullback. So it is interesting, though, to see the institutions getting out, why euphoria, of course, is what's driving this market higher. Fear and greed, up again, 79 versus 75. All signals remain positive, short-term, mid-term, and long-term. As always, we appreciate you watching. Thank you so much. This is Michael Loftus for Wealth and Wisdom TV.